Hello, my name is Ray Bowman. I've been involved in international trade for over 30 years. I'm a certified global business professional. I am the director of the EDC Small Business Development Center, which is an SBA-funded program that provides free business advising services to small and medium-sized companies. I'm also the program chair of the Southern California District Export Council. We're volunteers appointed by the U.S. Secretary of Commerce to promote U.S. exports. I'm also a professor at California Lutheran University as well as Santa Barbara City College, teaching classes in international business, supply chain logistics, trade finance, and import-export. I also belong to a variety of trade organizations, including the American Association of Exporters and Importers, as well as NASBITE, who not only sponsors the CGBP certification, but is also dedicated to the idea of teaching and outreaching to small and medium-sized businesses in international trade education. So in this lesson we're going to talk about letters of credit. Letters of credit are one of the four basic payment terms. As much as they're one of the four basic, they're probably the least popular because of the costs involved and the documentation involved. Having said that, it's very important to understand the concepts behind a letter of credit. It's also important to fully understand a letter of credit because many of the terms and conditions and practices under a letter of credit are very useful when we set up the terms and conditions under the other types of payment methods like open account. So it's very important to study these. So a basic definition of a letter of credit is it's a document that obligates a bank to pay the seller for a shipment based on the submission of documents within a given set of guidelines. Another way to think about it is it's a letter of credit replaces the creditworthiness of an international buyer for that of their bank. So in this regard, you can sort of think about it much like we use a credit card. When we use a credit card, we're essentially substituting our creditworthiness for a bank that's given us a line of credit. So it works in much the same way. The letter of credit guidelines, or the guidelines that are used by international banks, are those of the UCP 600. The old version was the UCP 500, so there were some changes with the UCP 600. You also may hear the term EUCP, which basically represents the UCP 600 that allows for electronic presentation of documents by both buyer and seller. The UCP rules were established by the International Chamber of Commerce, or the ICC, and the UCP helps define the differences between contracts and payment terms, bills of lading conditions, definitions for carriage, discrepancies, what those discrepancies are, document submittal, and what those conditions are under that document submittal, as well as the critical dates associated with a letter of credit. Also, when we think about letters of credit, it's very important that we focus on documentation because it's documentation that really drives payment on a letter of credit. So there's some basic documents that we should understand. The first is the pro forma invoice. Now, a pro forma invoice isn't an invoice, but what it is a rate quote. In other words, it's demonstrating what the final invoice will look like between buyer and seller. So many of us think of it as an official quote, and it's required as part of the application process for a letter of credit. The other critical document is the letter of credit itself, or what we call the MT-700. An MT-700 is standardized throughout the banking world. It basically lists all the critical terms and conditions that are part of a letter of credit. The MT-700 can also be a good template for establishing the terms and conditions critical to any payment method. So it's good to know what's in an MT-700. Also, a commercial invoice. Now, the commercial invoice is the bill of sale between the international seller and the international buyer. We also need the bill of lading. So the bill of lading is the carrier's receipt. I often draw the analogy between a bill of lading and an airline ticket or a bus ticket. It's a type of carrier receipt. And we'll talk a lot about bills of lading and why they're important. The other thing is the packing list. The packing list shows how goods are packaged in a given shipment. It's important because you may have one order that covers multiple shipments. So because of that, you need a way to be able to keep inventory over whether that order is being fulfilled under one shipment or multiple shipments. It's also important for claim purposes, verification that the goods have shipped. The other important document is what's called a draft. Now, a draft looks a lot like a check, but it sort of works almost in reverse of a check. Basically, the draft is submitted by the international seller to the international buyer as a demand of payment. Now, when a letter of credit is compliant and the documentation that's required is complete, the international bank will accept that obligation. When they accept that obligation, that draft becomes a negotiable instrument. So we'll talk a lot about that in a little bit. So looking at the basic structure of a letter of credit, you have a seller and a beneficiary. So basically what happens is that international buyer is going to produce an application. That application will result in generating that letter of credit. Now, that letter of credit issued by that bank is going to be issued based on two basic conditions. Either the international buyer will either have funds in the bank representing the letter of credit that they want to generate, or they will have a line of credit representing that amount. So now the buyer issues that letter of credit through their bank. We call the buyer's bank the issuing bank. Then that letter of credit goes back to the seller. Now the seller has to comply with that documentation. So the seller is going to get a set of instructions of dates and terms and conditions that they will have to meet in order to get paid. Now again, performance in a letter of credit is based on the submittal of documents, and goods have to be shipped so that all the documents are fulfilled prior to that seller getting paid. So basically, under letter of credit, the seller is delivering or shipping merchandise prior to getting paid under that guarantee of a letter of credit. So, very important distinction. Now, forwarders play a very important part in a letter of credit because they generate the bill of lading. So if we look here, we see the seller. The seller is going to get the letter of credit. They're going to perform against that letter of credit. Now, part of what they're going to do is communicate the terms and conditions of the letter of credit to their freight forwarder. Their freight forwarder, looking at those terms and conditions under the letter of credit, will then make the specific booking that will get the goods there within the date specified. They will generate the bill of lading. Then that bill of lading will go back to the seller and be part of the document set that will eventually go to the buyer's bank or the issuing bank for ultimate acceptance. So if we look at the overall structure of a letter of credit, we have the seller. The seller generates the draft according to the letter of credit, as well as the rest of the documents. So they're going to comply with all the dates, terms, and conditions. In other words, if the buyer is requiring a certificate of origin, inspection certificate, whatever is required, they will include all of those documents within the document set. And if everything is in compliance, then the buyer's bank is obligated to pay on that obligation. Now that means when they're paying on that obligation, that means basically they're accepting the demand to pay under the draft, and then that draft goes back to the seller, and that becomes a negotiable instrument by which they're paid. Now, not all letters of credit are compliant. You might have what we call discrepancies. In other words, maybe the ship dates weren't right. In other words, shipments were delivered late. The goods didn't make that sailing. Certain inspection certificates weren't presented. So you might have a situation where the seller submits documentation to the buyer, but those documents weren't compliant with the original set of instructions. If that happens, you have what's called a discrepancy. Under a discrepancy, the international buyer or the international buyer's bank is not obligated to pay. So at that point, you're back to negotiating with the buyer to see if you can get them to still accept or not get paid on that letter of credit. So looking at the overall structure of a letter of credit, again, the seller will issue the draft, the buyer will issue the letter of credit, and so the instructions go to the seller. Likewise, the seller will submit the draft in order to get paid. Now, there's different types of letters of credit. So again, I should also mention that with the seller beneficiary, the seller also has their bank that they work with, and that is called the advising bank. So in any international letter of credit, unless it's for electronic submittal, you generally have both the buyer and their bank, or the issuing bank, or the seller and their bank, who is the advising bank. So always think in terms of buyer, seller, the buyer's bank, and the seller's bank. Now, there are different types of letters of credit. Now, keep in mind, under a letter of credit, the negotiable instrument, in other words, the thing that becomes the money that is paid, is that draft. So you can have, like any payment instrument, you can have time built in to that payment method. So in other words, in open account, you could have open account with 30 days to pay. You can have advance payments that are advance payments 6 months prior to shipment. You can have documentary cash against documents with payment built in. So the same thing with letter of credit. You can actually build in a letter of credit that allows time to pay after the documents have been accepted. So this type of letter of credit is what's called a usance letter of credit. So basically, a usance letter of credit is a letter of credit where once the buyer accepts the obligation, they have time to pay because the draft allows for it. So that draft has time terms built in it. You can go from 30 days up to 180 days on an international bank draft. So think about it. Rather than having an open account, which is high risk for a seller, so that you can give someone time to pay, here's an alternative. You can have the guarantee under a letter of credit, right? The guarantee from the buyer's bank, while at the same time giving that buyer time to pay. So this is a very good alternative. It's also a way of credit checking the client very quickly. So if I'm an international seller and I have a buyer who wants 30 days to pay, if they can't get a usance letter of credit from their bank, that basically means that their bank is stating that they either don't have the cash on hand or they don't have the credit. So this can be a good way of making sure that that your potential buyer is creditworthy. Another type of letter of credit is what's called a transferable letter of credit. Now, under a transferable letter of credit, you can have two beneficiaries. So these beneficiaries are both parties within the letter of credit, and they both receive drafts. So if you can imagine a letter of credit where the buyer accepts the obligation, but they're paying two different beneficiaries. So there might be several reasons why you would have two beneficiaries. You might have a seller of the merchandise, but you might also have the freight forwarder who's getting paid their freight charges as a beneficiary on the letter of credit, or you might have a funder, or you might, or your seller might be a representative representing a product, and the other beneficiary may be a manufacturer. So there's a lot of different reasons, but this is a really good type of letter of credit. It's used especially in situations where sales reps want to make sure that they get their commission, so they basically write themselves with the agreement of all the parties into the letter of credit. Now the downside is because both beneficiaries are transparent to the buyer, Oftentimes you might have, let's say, a seller who is outsourcing the manufacturer, and they don't want to reveal their sources on the other side, so there'd be a downside to using this kind of transferable letter of credit. So there's another type of letter of credit that if you want to pay another party or have another beneficiary, there's another way to do it that's not quite as transparent as doing a transferable. And that's called an assignment of proceeds. So with an assignment of proceeds, basically what happens is that the beneficiary or the seller has the right to issue proceeds from their letter of credit to another party. So the difference in assignment of proceeds is that the party getting the assignment is not enjoying a bank guarantee. They're not part of the letter of credit. They basically get a letter from the seller's bank saying that they will get paid from the proceeds of a letter of credit. Now, for a lot of companies, they're very comfortable with this type of procedure. In fact, I know a lot of funders, a lot of companies that do alternative financing, that recover their loan amount on short-term financing by getting an assignment of proceeds from the transaction. So there's a lot of advantages to doing it this way. It keeps the letter of credit simple. It allows you to keep that other party a bit of an arm's distance away without the buyer understanding or knowing who that party is. Another kind of letter of credit. Now, the types of letters of credit that we've mentioned so far are what's called documentary letters of credit. In other words, they're performance driven. They're guarantees based on the submittal of compliant documentation. But there's another kind of letter of credit, and this type of letter of credit is actually more popular than what we call the documentary letter of credit, and that's called the standby letter of credit. Basically, a standby letter of credit, it's used in a lot of different ways, but the most popular use of it is to be a formalized way of giving collateral. So in other words, a standby letter of credit is an amount that can be put up based on performance of either the buyer or the seller. Sometimes sellers use it to fulfill obligations of bid bonds. In other words, a seller might do a standby letter of credit to ensure their performance in a project, let's say a construction project with an overseas buyer. A standby letter of credit may also be used by a seller to gain credit terms. In other words, they may put a certain amount of money in a standby, and if they don't meet their payment obligations, then that buyer can collect on that standby letter of credit to recover and thereby reducing their risk. Now, a bit of a caution on using standby letters of credit to gain open account terms with a buyer. You can end up paying twice if you don't look very carefully at what you've agreed to in terms of payment terms. So for example, let's say that you have 30-day terms with a company overseas as a buyer. That company overseas has asked you to pay in 30 days. Let's say that you paid on day 31 and they collected the standby on day 30. Well, the bank's obligated to pay that obligation out. So you have to be very careful if you're a buyer, again, if you're a buyer and you're using a standby letter of credit as a way of gaining access to open account terms, because you can end up paying twice. But given being careful, it can be a good way of gaining access to open account terms when you have a seller who's hesitant about doing that. Now, a letter of credit has 4 critical dates to it. So the critical dates are the validity date, in other words, at which date that letter of credit is fully funded and you can execute against it. The expiration date, all letters of credit have expiration dates, so if you perform after that expiry date, the guarantees of the letter of credit don't apply. You have shipping dates, last days that you need to ship the goods under the letter of credit, and then you have the last day to submit documents. So the shipping date will come prior to the document submittal date, because one of the documents you always have to submit is a bill of lading. So think of those 4 dates. Those are important in your management of a letter of credit. So the next thing we're going to go over is the MT700. So this is called the SWIFT MT700, and it's basically the message format of a letter of credit. So you can kind of think of this as the roadmap for how a letter of credit is put together. So it starts out with the sender name, in other words, the bank that's issuing it, who the receiving bank is, what the SWIFT code is. Basically, SWIFT codes are codes that banks use to identify and transact business with each other. So those are very important codes. It's a kind of encryption system, double encryption system that banks use to ensure security. You have the document or the form of documentary credit. So in here it says irrevocable. All letters of credit now under the UCP 600 are irrevocable, but you still want to make sure that that field is filled out correctly. You'll have the letter of credit number, the date of issue of that letter of credit, the date and place of that the letter of credit expires, so that's very important, one of those critical dates. Who the applicant is, in other words, the company that actually applied for the letter of credit. The beneficiary, in other words, who is the company that's going to benefit from this transaction. The currency amount of the transaction, so a letter of credit can be in any currency you choose, so you have to make sure it's the correct amount. The bank that is actually issuing the letter of credit, where it's going to be available. Where the tenor of the drafts, in other words, is this a regular letter of credit where the drafts are at site, or is this a usance letter of credit where there's a tenor to the draft? There may be 30, 60, 90, up to 180 days. Who the issuing bank is, who the beneficiary is, where the goods are available. Are partial shipments allowed or not? So in a letter of credit, you can ensure that the entire shipment is fulfilled. The entire order is fulfilled within a given shipment. Or you can say that you can have partial shipments. In other words, you may have a letter of credit that represents 6 months of ordering activity, and this is and you're going to have many shipments within that 6 months. You can also allow for transshipments. So basically, think of a transshipment as either choosing a direct path or a direct flight, let's say, or let's say that you're allowing the option within that letter of credit for the seller to have more than one stop or more than one routing to get to the ultimate destination. So if you allow for transshipments, it gives the seller more options to get the goods to you. Now, you may not want that because you don't want the goods stopping off at intermediate points before they get to their ultimate destination. The loading, where the goods are going to be loaded, where the goods will be transported to, description of the goods. So in a letter of credit, you might have very specific descriptions, or you might have very general descriptions that just say the goods and material per the pro forma invoice, or you may have the exact description within the letter of credit. I always recommend that you have a more general description referring to the pro forma invoice, because that makes it easier for the letter of credit to have fewer discrepancies. What are the documents required? So as a seller, you want to make sure that the documents required under the letter of credit are ones that you can produce. You don't want to accept the submittal of documents that you're dependent upon the buyer to give to you, because that can set you up for discrepancies. And again, we go on with the different documents that may be required, and again, different shipments may have different documentary requirements. There might be other clauses and conditions that may affect the letter of credit. So this is part of the format of the MT700. Any changes? Period of presentation. So in other words, when do these documents have to be presented? is the letter of credit confirmed or not? Basically, a confirmation of a letter of credit means that another bank can take over the responsibility of reviewing the documents. So let's say that you had a transaction to a bank in Korea, and the bank in Korea was the ones who would normally review the documents on behalf of the buyer and issue the payment. Well, let's say that you wanted to speed up the transaction and have a bank in New York review the documents instead. You could pay a fee for that bank to take over the obligation of reviewing those documents for completeness, and that's what's called a confirmation. Now, most banks in most countries will allow for confirmation of their letters of credit. Now, there are some exceptions. For example, in China, Chinese banks, by and large, do not allow confirmations of their letters of credit. So it's good to check about confirming letters of credit. Now, again, there's an additional cost to doing this, but part of the advantage of doing a confirmation is working with a bank that you might be more comfortable working with, or cutting down on the lag of sending documents to an overseas bank. And those are basically the structures under an MT700. So looking at that, looking at what those terms and conditions are, a lot of those terms and conditions would be the same terms and conditions that you'd have under a basic agreement between a buyer and seller. So I always like to focus on the importance of the terms and conditions within an MT700 because they provide a good framework for buying and selling agreements using other payment methods. So again, in summary, there are 4 dates to a letter of credit. So there's the date the letter of credit is effective, the date it expires, the last date to submit documents, and the last date of shipment. So those are critical dates to remember. In a letter of credit, you have to make sure that the funds are drawn on the buyer's bank. If the funds are drawn on the account of not the bank, but the account of the buyer, then that's not a true letter of credit. That's a documentary collection. Now, there are some exceptions. In countries like India, there's an additional process that makes it look a little bit different, but by and large, for most letters of credit, you want to make sure that the funds are drawn on the bank of the buyer. Required documentation. You want to make sure, if you're the seller, that the documents required under the letter of credit are documents that you control, that you're aware of, and documents that you can produce, not documents that are produced by anyone else, such as the buyer. You also want to be conscious of whether partial shipments are allowed or not allowed. That can be an advantage to the seller, giving them more choices, allowing them to fulfill an order in multiple shipments. But you have to be aware whether that terms and condition will be there. Also, transshipments. Transshipments, if they're not allowed, that can limit the amount of choices that an exporter has in getting the goods to the buyer. So, very important. And being conscious of the ship date. A lot of discrepancies happen because ship dates weren't made. And looking carefully at the letter of credit instructions, working carefully and closely with your freight forwarder to make sure that you understand those terms and conditions, working closely with your bank, and using other business assistance programs that can help walk you through letters of credit. Another note is there are some companies out there that are outsourced companies that will actually handle a letter of credit for you. So sometimes it's good to use those companies, especially if you're not comfortable with letters of credit or not comfortable with a particular type of letter of credit. So these are all important resources. And then making sure that in a letter of credit, it's critical that the documents must match, and they have to match exactly. So a letter of credit, attention to detail in making sure all the terms and conditions and all the documents match in terms of the description of the goods, the ports, Literally, if there's a misspelling, the misspelling should match on all documents, so you have to be very conscious of those things. Now, under the UCP 600, there's a lot more allowances, but it's better to err on the safe side and make sure that your documents match perfectly. And bill of lading is title document. So within a letter of credit, the bank, the buyer's bank that receives the bill of lading, what they're supposed to do with that is if the terms and conditions of the letter of credit, all the documents have been met under those terms and conditions, then the buyer's bank will release the bill of lading to the buyer so that they can clear the goods through customs and take delivery of them. Now, it's very important to understand that because the banks will hold the documents in both terms of air freight, ocean freight, truck bills of lading under a letter of credit. But the one thing you always want to be conscious of is the fact that only an ocean bill of lading, a true ocean bill of lading, is a title document. In other words, that document can be held, and if it isn't released, the buyer cannot get the goods. This isn't the same with other types of bills of lading, like truck bills of lading or air freight bills of lading. Even though the bank is holding the original bills of lading, those types of bills of lading, the buyer can still get a hold of the goods. So it's very important to make sure that you understand which bills of lading perform as true title and which don't, regardless of how the bank looks at them. So it's very important to understand that. And understanding that bank drafts trigger payments under that. So you can set up terms and conditions under the drafts, under the letter of credit, which trigger payment from those drafts. So the draft is actually the negotiable instrument in a letter of credit. And if you have multiple, allows for multiple shipments, in other words, partial shipments are allowed, you can have multiple drafts under a letter of credit. So let's say that you have one letter of credit that covers 6 months of activity. Every time you ship, that will trigger a draft. So it's important to know that as a feature within a letter of credit. And you don't want the description of the goods to be too specific. In other words, you can refer to the pro forma invoice and the description of goods and services under that as a description under the MT700. So that just simplifies the letter of credit process.